Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. The UK stock market has faced challenges in recent years, but is sentiment starting to shift? This week's guest discusses why international investors are showing renewed interest in UK equities and gives his insights on finding reliable income in a low-growth economy.
I'm Darius McDermott from FundCalibre, and this is the Investing on the Go podcast. Today, I'm joined by Jeremy Smith, who is the fund manager of the CT UK Equity Income Fund. Jeremy, good morning.
Good morning. Hi.
So let's jump straight in. UK equities having a slightly better time of it year to date so far. Not a bad return last year, but they've genuinely been shunned over the last near enough decade now, post-Brexit vote, etc. Do you think international investors are starting to look at the UK for value again?
Yeah, there's been more and more interest from international investors. Mostly, I have to say, in the last sort of 12 months, European investors that are looking a bit further afield from their own economies, which are clearly struggling. So the largest economies in Europe, like France and Germany. And they're really attracted by the 10-year low valuation of the UK market against not only their own market, but most particularly, the world market, where I think we were trading at a 40-year low. So, yes, there's definitely more interest, not just from institutional investors, but also, of course, we've got activist investors, we've got private individuals looking to make money out of buying very cheap UK shares.
Yeah. No, there's definitely a lot of interest in the UK stock market from overseas, which is picking up, which is great. So let's dive into the funds, pick on a couple of sectors that have either worked or not. Industrials has been a key contributor to the fund's returns. What is it attractive about that, and where do you see the further opportunities ahead?
Yeah, it's a good question to ask. It's been a structural overweight for the fund for many years. Our belief philosophically is that industrial companies have the same sorts of exposure to global GDP as commodity companies, so miners and oils, but have much greater control over their ability to influence profitability than commodity companies do. So, the oil price, the iron ore price, in the short term, will have a much greater bearing on the profits of Rio Tinto and BP than in industrial companies that have much more diverse end markets geographically and also from a divisional basis, and therefore have much greater control over their own profitability. So we get exposure to recruitment, to building products, to business services, but they're all exposed to global GDP in the same way over the long term. So we think it's a much more risk-averse approach and gives us better protection across an economic cycle.
And I take it then from those comments maybe that you are underweight some of those commodity-linked sectors where, as you've already described, the price of the commodity maybe drives profitability rather than the company?
Yes, I mean, we're very focused on the long-term sustainability of dividend income. Pretty much all of those companies now in the mining and energy sectors are on fixed payout ratios. So the dividend is a proportion of the earnings earned that year. So it can vary quite a lot, clearly dependent on what end pricing is for those particular commodities. In terms of putting a portfolio together that's going to give year-on-year growth in dividend income and give you a yield tilt at the portfolio level to trade at a yield premium to the benchmark, which is the London stock market, we take careful consideration over those individual names in the portfolio. So philosophically, we tend not to invest in them, and we tend to prefer other names that give us the same sort of exposure, but better protection on that year-on-year sustainability of dividend income.
Yeah, of course, this is an income fund, and you've got to target it at premium income. So I suppose that aspect of a company's ability to pay the dividend and a growing dividend is important. What then is your thinking on the banks? Because banks have been a very strong performing sector over the last, 12, 18 months. The UK's got lots of larger banks that have now returned to paying dividends. post the sort of COVID blip. What's your view on those and their ability to continue to pay those dividends and the outlook for the banks generally?
Yeah, I mean, you're right. I mean, they've been very good cash returners. It's been a headwind in terms of relative performance for the fund, most particularly last year, where you saw share prices like NatWest and Barclays pretty much double over the course of the year. I mean, we still outperformed the index last year because of the other contributors within the portfolio, but we would have done a lot better if we'd had some banks as well. And we've tended to focus again outside of the banking sector on other financials, again a bit like the industrials, where banks ultimately are recipients of income based on the 10-year yield curve, which is determined by governments and currencies, etc., and views on economies. Again, in the short term, there's not a lot that banks can do if yields change dramatically or even slightly at the short end or the long end. That materially influences their P&Ls. They've been locked into this hedging, which they've taken out in the last few years, which has given them quite a good buffer. But that will start to roll off as we head into the future. We think they're quite fairly priced now. But they are good cash. They are good cash returners to shareholders. The real time to invest in them was in Q4 2020, which is sort of pre-vaccine, and they were trading on very low valuations to book. At the time, we looked at them a lot, and in the end, we decided we would average down in our existing exposures to the UK economy. Shares like Marks and Spencers, actually at the time were 90p, just like NatWest was. And again, we've made sort of 4 or 5 times our money from doing that. So we've not lost out, but we didn't own the banks.
Well, that I suppose is the job of the fund manager, is to decide which of these opportunities presents the greatest opportunity for some capital growth as well as that dividend
exactly
growth. So we know you can't win them all and you can't lose them all either. But
exactly.
So I do want to come on to the outlook for your outlook for the UK economy, but I think we've just touched on it in the earlier part of our conversation. There are others now finding real value in the UK market. We've seen a number of takeovers in the investment trust world and activism, an area that I'm very familiar with. But M&A is picking up, and it's not just that sort of side. What's your view on how attractive UK companies are to other buyers, whether it be private equity or private companies or private individuals?
Yeah, I mean, we've sort of, I think we're in the 39th month of consecutive outflows from our domestic wealth management industry from their UK exposures. So, that forced selling has had a much more material impact lower down the index. So mid caps, small caps have seen valuations change really quite materially. Because on the other, there's just been effectively more sellers than buyers. And in that vacuum, as I said, we've had some institutional buying from European investors and some US value funds. So the likes of Travis Perkins, for example, I think half their shareholder register is US domiciled funds now. But you're right. I mean, the last year was an absolute boom for M&A in the UK, corporates and private equity. And I think of the 14 largest transactions we were involved in 9 of them. So our focus on intrinsic value or fundamental value, or however you want to call it, what is it worth to someone else? Never mind what it's worth today. We have a very, very, very strict 3 to 5 year investment horizon, and so no matter how much noise there is today in terms of short-term earnings changes, we stay very focused on that long-term value, and that gives us in this particular environment quite a competitive edge in terms of having more than our fair share of bid approaches. Some of which, to be honest with you, are not welcome. We rejected the bid for Royal Mail. We rejected the bid for Hargreaves Lansdown. I mean, they still went through, but we don't want our best ideas going out at the wrong price. And with so many shares trading at such abject valuations, We continue to act very much as active owners with boards where we've got significant holdings, and to say to boards that, you're going to go out at the wrong price. We don't want to lose this great business off our exchange at the wrong level. And boards are finding themselves in very difficult positions because of the very low share prices.
Yeah, I suppose when they come at a noticeable, if not significant premium to the share price, some investors are going to want to take that uplift. And yeah, I slightly wonder about the de-equitization. As you say, big parts of our market are cheap, and it is now starting to be spotted. And well done for having an interest in so many of those large M&A opportunities last year. So let's just talk a little bit about the UK economy, what your view is, and how you go about searching for that reliable income in a low growth UK economy. I think the January figures came out, which were negative recently. It's not like the UK is booming at an economic level.
Not at the headline levels. No, that's true. I mean, this sounds very outrageous, but we could be on the cusp of a consumer boom in the UK, which I'm sure most people would laugh at. Given the recent headlines, all of the foundations are there for a 1980s style consumer boom. The housing transactions are running at very low levels. I think it's the builders merchants building volumes of 40% below their 10-year average. The savings ratio is more than double the long-term average. Debt to GDP for households is at 2000 levels, so 20-year lows. So we've had 9 months of consecutive double-digit growth in disposable incomes as measured by the Asda income tracker. So the average person in the UK, regardless of the Daily Mail headlines, is in a much better position than they've been for donkey's years. And courtesy of COVID, courtesy of inflation, and certainly double-digit national wage rises every year, the bulk of the population of the UK is in pretty good shape. The main issue at the moment is consumer confidence, because people are very affected by headlines. The budget in November had a fairly catastrophic impact on people's willingness to want to spend on big ticket items. So I think, new car sales are at 5-year lows, but people are spending like billio on going away on holidays, restaurants, clothing. So there are avenues where people are spending money. We use the macro to inform us rather than to decide the stock selection. But there are pockets, where because of Brexit, because of COVID, because of cost of living, those companies that have survived, that are listed, are in a much better place today than they were 10 years ago. So, the likes of Tesco, Marks and Spencer's, they've powered ahead mainly because a lot of competition has really struggled. We've invested into real estate for the first time in 10 years. Those listed players there have got very low leverage versus their net asset values, and there's been a real survivor bias, in terms of retail centres. There used to be 200 quite well attended shopping centres in the UK. There's now 30. Land Securities that we owns 9 of them. So and rents are going up in all of them, because if you're Primark and you want a bigger site, or you're Next and you want a bigger site, I'm afraid it's going to cost you a lot more money, because no one's built a new shopping centre in the last 15 years. So there's a real survivor bias, and the bigger companies have come out much stronger and are in much better competitive positions. So we're still finding some good ideas out there.
Brilliant. Well, it's nice to hear somebody actually cheery on the UK rather than the opposite side. So very, very interested in that. So maybe finally, what's the one part of the UK equity market you think is still being unfairly overlooked by investors right now? And where might you see best opportunities for income and growth over the next year, 18 months?
Well, I mean, the glib answer to that is pretty much everything below the top 30 stocks in the index, to be honest with you.
I thought you were going to say the mid caps. I thought that was the obvious answer.
I mean, we've sort of, through our quite strict criteria looking for a new idea, we found ourselves double weighted in mid caps. It is certainly, not only is the UK market trading at a 10-year low against the world MSCI benchmark, but mid caps are trading at a 10-year low against the FTSE 100. So, it's basically cheap on cheap on cheap. And we have got some absolutely excellent businesses that are listed there, through no fault of their own. They're listed on the London stock market. Many of them have got absolutely nothing to do with the UK economy. They're world leaders in what they do.
Yeah.
So we've got some good niche companies doing extremely well. And ultimately, we are a fundamental bottom-up valuation sensitive strategy, and so all of those characteristics have led us towards the mid caps, which you think are very cheap.
Brilliant. Jeremy, thank you very much for that interesting discussion on your fund and, of course, the UK. And as I say, nice to hear a little bit of optimism rather than maybe some of the gloom that the headlines lead us to.
Jeremy looks for unloved companies with the ability to sustainably grow their dividends. The fund is unconstrained and has a contrarian value bias. Jeremy's looking for hidden gems and businesses with long-term potential. To learn more about the CT UK Equity Income Fund, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.